Hello, my name is Armando Villegas, and I'm with Israel and Jesus. We will be talking about the real estate crash of 2008 and 2012. First, I will start with a little overview. The real estate crash occurred in 2008, and it was the worst housing crisis since the Great Depression. Millions of people lost their homes, lost their jobs, and the global economy went to shambles. The 2008 real estate crash didn't necessarily start in 2008, but a combination of factors such as a subprime mortgage crisis, high levels of debt, and lack of regulation in the financial sector was the cause or the root of this historical event. For example, by September 2008, the housing prices have declined by 20%. This unexpected decline caused the house price to decline and caused negative equity for families and investors, thus pretty much saying that their mortgage was worth more than the value of their home, causing pretty much the closest thing to the Great Depression that we have today. Now I'm going to pass it on to Jesus.
Okay, so I'm gonna go ahead and explain a little bit of more detail the subprime mortgage, what it is and what are we referring to every time we say subprime mortgage. A subprime mortgage, it's pretty much borrowers with less than ideal credit history. So pretty much on poor credit histories will get a loan, a subprime mortgage. Also, if you had a late payment history, or you have a higher credit risk, you'll be able to qualify for a mortgage. Unlike today, that it pretty much is really difficult to qualify for a mortgage. Some of the key features are higher interest rates, basically on these mortgages. They're adjustable rate mortgages as well. So they're not a fixed rate. It could fluctuate depending on the interest rate. And also there's the teaser rates, which is interest rates that later increase throughout the initial period. So let's say you get a lower loan your first couple months, but as the months get by, your loan starts to increase for the interest, and making it really difficult for you to accommodate a fixed income. Overall, these subprime mortgages loans are really high risks of defaults. Okay, so with that in mind, I'll go ahead and go into the housing bubble and the subprime mortgage crisis, which happened from 2000 to 2007. In the mid 2000s, there was a substantial increase in housing prices. Pretty much there was a lot of demand. There was low demand for the mortgages, which increased the prices on the homes. Also, there was low interest rates, unlike today, and there was a lot of speculative buying. Also, the lending was really relaxed, and there was a low requirement standards to afford a home back in those days. The financial institutions would issue large subprime mortgages to a lot of home buyers with poor credit, initiating kind of like the problem with the crisis. And after the institutions would provide these customers with loans, they would bundle it into a complex financial product and then also sell it to investors. And then I'll go on to the next slide. The next slide is financial instruments and derivatives. Financial instruments created by the institutions like collateralized debt, obligations to package and sell mortgage-backed securities. So similar to what I was saying earlier, also the lack of transparency and understanding the risk associated with these financial instruments, which eventually caused some of the banks to collapse, like this one, which is the Lehman Brothers. The Lehman Brothers were a major investment bank heavily involved in the subprime mortgage market. They declared bankruptcy in 2008. And after the bankruptcy was cleared, it started a cascade of bankruptcy, and it followed a cascading of panic in financial markets, and also there was freeze in credit markets. Okay, so eventually leaded to global financial crisis, the collapse of the Lehman Brothers. Banks had liquidity problems around that time. Housing prices were plummeted. There was a surge in foreclosures, and a lot of homeowners were underwater, owning more on their mortgages than the homes were worth. So there was no way to escape the loan, due to the subprime mortgages, and which eventually it translated into a broader economic downturn. Unemployment rose significantly, and consumer spending contracted, making the economy to slow down severely. Okay, and I'm gonna go ahead and bring it back to Armando so he could explain.
Perfect. Thank you, Jesus. Now I'll be talking about securitization. What is securitization? It is a conversion of assets, especially a loan, and they form it into marketable securities. Typically, the purpose of these securities is raising cash by selling them to other investors. Therefore, the plan for these financial institutions during this crisis was to bundle these subprime mortgages that we were recently just talking about with other types of loans, and then we would sell them as mortgages. The problem with that is they're trying to hide all the bad stuff that's going on. So they're obscuring the riskiness of these underlying loans, and they're selling it as mortgage-backed securities to these investors, knowing that there could be problems later on. In addition, securitization of home mortgages fueled the excess of risk taking. So more people were investing, more people were buying it, more people were getting approved when they shouldn't have been getting approved and when they shouldn't have been investing, including Wall Street banks and originators such as Wells Fargo and Citibank. So when the US housing prices began to fall, mortgage delinquency soared, people couldn't pay, and investors weren't getting paid or getting their incentives back. And they're leaving all these banks in pretty much shambles. So now we'll be talking about the rising of the house prices. So during the 1990s and early and mid 2000s, the economy was booming, especially the housing economy. It was rising in prices. So many people had that thought in their head, buy now or miss out. So everybody was buying, like I said, getting approved for loans that they weren't supposed to be getting approved for. And eventually those interest rates towards the end of their payments were getting too high for them to pay. Unfortunately, the lenders were out of luck, and eventually the government had to get in and have to bail them out eventually. So now I'm going to pass it on to Israel to speak more about it.
Thank you, Armando. Another major factor of the 2008 housing market crash was the credit rating agencies. These agencies would rate the credit worthiness of these mortgage-backed securities. The top three that are well known are Standard & Poor's, Fitch Ratings, and Moody's. There are other smaller credit rating agencies that did their part in this situation. But basically what they would do is that leading up to 2008, these agencies were giving high ratings to these loans, knowing that they were actually high risk and low quality. They would give them like triple A ratings, knowing that they're possibly more like triple B or even triple C ratings. Especially when they would bundle up these mortgages together, there would be a mixture and diversity in different types of mortgages. So there would be a combination of level B ratings and level D ratings mixed with AAA ratings. And so altogether, they would just grade them all as AAA. This would encourage investors to buy these securities, not knowing that they're really buying a faulty product that is not stable. It's not really profitable. But the goal of these agencies were to increase their own profits and market shares by giving these inaccurate, strong ratings. In a way, I know that some of them were almost encouraged to contribute to this situation because if they didn't give the AAA ratings that the lenders were looking for, the investors were looking for, they would take their business elsewhere. So in a way, it was more like a competition thing where it's either you give us what we want, or you give us the rating we want, or we'll just go to Moody's. If you can go to the next slide, please. Thank you. Another major contribution to the 2008 housing market crash was the lack of regulation, the lax regulation that there was, the not strict regulations. That's just the government not doing their part in keeping an eye on what these banks and lenders are doing and not putting strict rules on how they should be qualifying people for mortgages and loans. The banks would offer these subprime loans to people who couldn't afford them, and there was no way. It was almost like if they were just allowed to give these subprime loans to anybody, when someone should have really been stepping in and telling them, no, this person can't afford it, you shouldn't be doing that. In a way, Congress would even encourage these firms to push the mortgage-backed securities as a way to promote affordable housing at the time. Since the housing market was so strong, it was very important for them to sell to even the low-income applicants who saw it as an opportunity to buy a house with these great deals in their loans. The government also guaranteed that these firms were too big to fail, which led to the rapid expansion of these subprime loans. But as we can see, it all ultimately led to their failure altogether. And I'm just gonna throw it back to Armando so he can finish it off.
Thank you very much. So how did our economy get bailed out? Basically, the government. So to address the crisis, Congress passed an Emergency Economic Stabilization Act in 2008. The act created the Troubled Asset Relief Program, also known as TARP, which authorized the U.S. Department of Treasury to buy up to $700 billion in toxic assets from companies who could then replenish the balance sheets with good assets. So basically, they bailed them out. They bought all the bad assets and replaced it with good assets. Pretty much bailing them out, pretty much buying all of their bad stock and all of the bad decisions that they made. The government paid for it and helped them out so they can stay in business, and none of the banks like Citibanks or Wells Fargo would go out of business. In addition to that, the Treasury Department was also authorized to buy $250 billion worth of shares from these banks when they were down under. And eventually, when they recovered, they made about $30 billion in profit. So they put about 245 and they came back with 275 billion. So there was some incentive to bail out these banks and help our economy along the way. Thank you very much. My name is Armando, and on behalf of Israel and Jesus, we thank you for listening.
Thank you.